Hi, and welcome to the Stockscores Market Minutes for August 31st, 2015. Well, it makes some sense this week to talk about the dead cat bounce because that is what we had in many stocks this week, sharp rallies after the big correction. You know, fear causes markets to sell off much sharper than they go up. There's the saying, uptrends take the stairs and corrections take the elevator. What happens in an environment of fear is that irrational pricing tends to push price down quicker or farther than it should go. And this leads ultimately to a tradable bounce. When the emotion goes away, investors realize that they've accepted prices that are too low for individual stocks, and you get a bounce back. We saw that early this past week. In order to take advantage of them, what you want to look for is a parabolic downward trend and then a break from a rising bottom on a short-term chart. Now I want to add that it's important on the daily chart to also have the stock move up and above its open. So here's a chart of Apple. You can see that we had a parabolic downward trend starting about 2 weeks ago, and then it went steeper and steeper and steeper. And then, of course, on Monday, we had that very sharp sell-off early Monday morning. And then the market came back to move above its open and ultimately broke from a rising bottom right where I have that blue arrow. Now, there was some opportunities to buy it on a 2-minute interval using the same setup, but I'm preferring here to use the 15-minute setup because it's a little bit more tradable for most people. So that was a good tradable bounce on Apple, and I actually bought Apple along with a few other stocks on Monday because it was breaking from a rising bottom on the short-term intraday chart after a parabolic sharp downward correction on very strong volume. It's basically everyone runs for the door at the same time, everybody gets out at the worst possible price, and then the market corrects back because the sellers are tired. And of course what's happened on Apple is we've had a nice run higher since then, and a very tradable bounce for those that took advantage of it. All right, well, let's talk about the general market now. This is a chart of the S&P 500. And you can see that the short-term chart, which is in this case a 60-minute, 30-day chart, broke the downward trend line on Wednesday after sort of testing the same low around that 188, kind of bounced off of it a few times. I recognize it went all the way down to almost 182, but you can see a few times here it was bouncing off of that 188 roughly price frame. It hit once, twice, 3 times, and then finally said, okay, the buyers are stronger than the sellers are tired, and we got a nice rally off of that Wednesday into Friday. So that's good for a trader. Big picture, still problems. We have the long-term upward trend has been broken, and that is very important. When you go back a number of years and you see a trend line that has held up for a number of years get broken like it has, don't think that we are out of the woods yet. I do think we could get another couple weeks of upward price action, but there's still a real risk that this market is going to roll over and continue into a lower trend. So I think you can take a little bit of fear out of the market, a little caution out of the market, but I still want you to be alert and keep a close eye on things. Russell 2000 bounced off of support, much like the rest of the market. Again, oversold, went parabolic to the downside, has come back this week to close well above its open for the week. I think it's got another week or two of upside until it hits this downward trend line. So if you're a trader, you can probably be fairly optimistic going into the next week or two, but you shouldn't take your eyes off the ball. You still need to be cautious because over the next 2 months, we could still have more corrective market action. TSX took out some of the emotion. When I say emotion, what I really mean is that the market ran away from its trend line. So there was the downward trend line. This again is the short-term chart going back just a month. And there you can see the emotion, real rapid sell-off into Monday of this week, just like all markets. We came back from that. And what's happened now, and I've said this many times in these videos, when stocks run away from their trend line, they almost always come back to the trend line. So there's the red trend line and ran away from the trend line. Now it's come back. I was buying stock on Monday because I recognized that the markets had run away from the trend line. And even though everybody was calling for the sky to fall, ultimately we get prices coming back to the trend line, and that's a trade, a 3 or 4 day trade. Doesn't mean that the market is going to be in a bull market for the next 2 years. It's strictly a short-term trading action. Longer term on the TSX, I would say still not a great looking chart. We've been sort of grinding sideways. You can go back basically to 2013 to see where we are at in terms of price now, maybe early 2014. So, if you've been invested in the Canadian market in the index ETF there, you've earned nothing in 2 years, nearly 2 years. So that's kind of depressing, but there are still trades to be made. There's still individual stocks that can do well. I just really caution right now with the Canadian market. I think you have to be pretty stock specific in how you trade. One of the ugliest places to be in the Canadian market has been the TSX Venture. That's the microcap stocks in Canada, mostly oil and gas exploration and mining exploration. And these things have been just brutal as commodity prices have gone down, as the US dollar has gone up. But they showed some signs this week that people may be taking a nibble on them, bargain hunting a little bit. And I think we could see a couple more weeks of upside before we hit that downward trend line. So if you do like to trade the penny stocks in Canada, you might get a little bit of joy out of them in the next couple weeks. But again, big picture, don't get too excited until the downward trend line is broken. That could happen. I'm just saying right now I want you to take a short-term view of this market because it's got a lot of work to do. Treasuries. I had thought the Treasuries would pull back with all the thoughts that the Fed was going to raise interest rates. To me, that meant prices were going to move down, which means interest rates go higher. It didn't happen mostly because the market was correcting and people were looking for a safe place to hide, so they were hiding in bonds. But we had a big reversal week. This is called a bearish engulfing candle, where the high and the low are wider than the previous week's high and low, and it's bearish because it's red. That means it closed below its open for the week. So that's a pretty good sign that the bond market wants to move lower, interest rates go up. It's still got a little support at the old trend line there, so we could see a bounce off of that in the short term, but I think it's more likely that the bond market is going to move back into this downward sloping channel, which means higher interest rates ahead. Not critically higher, but certainly starting to price in a raise in rates by the U.S. Federal Reserve. U.S. dollar, because rates are expected to go higher, got a little support this week, coming back from weakness early to close up for the week and well above the open. Still in this flag pattern, so we haven't broken out of that yet. So it's still basically kind of a neutral pattern right now, but we shouldn't discount the fact that the U.S. dollar probably is going to be higher in a year, because if rates start to go up in the U.S. but not go up everywhere else because the rest of the global economy is still lagging, it's going to take time for those economies to catch up, and meanwhile money's going to flow into the U.S. economy, and the U.S. dollar is a safe haven. So that's sort of how it's looking like right now, but I think it's going to take a few weeks, even months, till it breaks out. Chart of gold. Gold got a little bit of a bid the last couple of weeks as the market was correcting, but proportionately, in the past 10 years, 20 years, if there was a big correction in the market, you would have seen a lot more money go into gold, and that really didn't happen. You had a little bit come in, and there was certainly some trades to be made. I mean, there was some gold miners that were up 20, 30% in 1 or 2 weeks. So it was a place to trade, and we had some fun with that. But, longer term, this is still a tough market to be in, and the long-term view, in my mind, is still bearish. Oil made a bullish engulfing candle this week. So we talked about bearish engulfing candles. Here's a bullish one. The low and the high are outside the previous week's range, and we closed well above the open, so that's why it's green. Volume very strong, so that tells me some capitulation, some reversal. This very well could be the bottom in oil. I would say 70 to 80% chance oil has bottomed here. Doesn't mean it's certain, it never is certain, but certainly it looks good for that. Doesn't mean also that it's going to turn around overnight. I mean, the bounce back this week was good. We saw some good moves in individual oil and gas names. For traders, you could have made 20% in a few days on some of those oil names. But there's a lot of work to do longer term for these things to turn around. So first thing we have to do is break that red downward trend line. That'll take some time. But a good positive this week, and I'm a little bit more constructive on oil than I have been in recent weeks. Fear, still pretty high, even though the market sort of corrected its correction at the end of this week with a pretty good rally. Volatility is still high. You can see the VXX is still holding up pretty nicely. But if the market continues to hold, you should see this move down, fear come out of the market. But it does show me, the fact that this is pretty high still, does show me that fear is still a factor in this market, and we shouldn't discount the fact that we could get further corrective action in the next 1 or 2 months. Could still happen. So we got to stay on our toes. And that's basically my comment this week. Stocks have come back well from the correction, but are not out of trouble in the long-term time frame yet. I like how things look, but there's work to be done. Oil appears to have bottomed. Look for continued volatility in stocks, which is good for traders with a short-term bias, but if you're a longer-term trader, I want you to just be pretty cautious still. Stocks are recovering, but the psychology is fragile, so stay alert. Well, that has been the Stockscores Market Minutes for August 31st, 2015. Have a great week in the market and trade well.